Hey everyone, welcome back to Corporate Decoder, the place where we try to make sense of big company secrets, and turns out today we're diving into UniFirst Corporation's latest financial report. And let me tell you, it looks like they had a pretty busy few months, especially with some interesting numbers in their income statement and balance sheet. So before we dive deep into the numbers, grab your coffee, and if you are new here, make sure to subscribe for more breakdowns like this and join our Discord community link. Ed in the description. We have some great conversations happening there. Alright, let's start with the big picture, the income statement for the 13 weeks that ended the 29th of November 2025. UniFirst brought in $621,318,000 in revenue. Now that might sound like a lot, but compare it to the same period last year, the 30th of November 2024, when they pulled in $604,900. So that is an increase of about 2.7%, which is pretty steady growth. Breaking that revenue down, we see that their Uniform and Facility Service Solutions segment is still the big driver at 91% of the total revenue. First Aid and Safety Solutions saw a nice jump of 15.3%, which is great news for that division. However, their other segment, which includes their nuclear business, saw a slight dip of 2.9%. This is likely due to the cyclical nature of the nuclear business and some large projects wrapping up. Now let's talk about expenses. Cost of revenues went up 3.1%, which is slightly more than their revenue growth. This means their cost to produce and deliver their services is rising a bit faster than they're bringing in money. But the real jump is in selling and administrative expenses, which shot up 10.7%. This is a significant increase, and the company cites investments in accelerating growth and digital transformation as key reasons. They also mentioned higher legal costs and healthcare claims contributing to this rise. While investing in growth is good, you want to see that translate into even bigger revenue gains. All these expense increases led to a drop in operating income. For the 13 weeks ending the 29th of November 2025, operating income was $45,308,000, down from $553,100 in the same period last year. That is a 18.4% decrease. Their operating margin also slipped from 9.2% to 7.3%. This is a bit concerning because it shows that it is costing them more to generate each dollar of profit. On the brighter side, other income net saw a decrease in expense, meaning they spent less money on things like interest and other expenses. This mainly comes down to lower cash reserves and lower interest rates, reducing their interest income. Their provision for income taxes also decreased by 14.9%. This is good news for them, but the effective tax rate actually went up slightly from 25.6% to 26.9%. The company explains this is mainly due to timing differences with employee stock options, which is a common thing in these reports. So what does all this mean for the bottom line? Net income for the 13 weeks ended the 29th of November 2025 was $34,363,000. That is down a noticeable 20.3% from $43,100 in the previous year. This is a direct consequence of those rising expenses outpacing revenue growth. Let's shift gears and look at the balance sheet. As of the 29th of November 2025, UniFirst had total assets of about $2.75 billion. This is a slight decrease from the 30th of August 2025, when it was around $2.78 billion. A big chunk of this involves their property, plant, and equipment, and a substantial amount of goodwill, which has actually increased throughout the year, reflecting their acquisitions. Cash and cash equivalents have taken a significant hit. They went from $203,501,000 at the end of August to $123,977,000 at the end of November. That is a drop of almost $80 million. The company says this is mainly due to their investments in capital expenditures, share repurchases, acquisitions, and dividend payments. Basically, they are spending a lot of cash. Liabilities also saw some shifts. Accounts payable decreased slightly, while accrued liabilities saw a bigger drop from $176 million to $154 million. This often indicates that they paid off some short-term debts or obligations. Total liabilities are down to about $590 million from $609 million. Looking at shareholders' equity, it remains strong at over $2.16 billion. Their retained earnings, which is essentially the profit they've held onto over the years, is a massive $2.07 billion. This shows a company that has been consistently profitable. Now for the cash flow statement, cash provided by operating activities has decreased significantly. It dropped from $58 million in the same period last year to just $14.8 million. The company attributes this to unfavorable changes in rental merchandise in service, meaning more goods are tied up in rentals and not generating cash yet, and also higher tax payments and accrued liabilities. Investing activities show a much higher outflow of cash. They used $52.1 million in investing activities compared to $37.5 million last year. This increase is primarily due to more spending on acquisitions, particularly in their first aid and safety solutions segment, and higher capital expenditures. This means they are actively growing and reinvesting in the business. Financing activities also show a larger cash outflow, going from $15.5 million to $42 million. This is mainly driven by a significant increase in the repurchase of their own common stock. They bought back about 194,100 shares in this period. This shows they are returning capital to shareholders. The company's board authorized a new share repurchase program for up to $100 million. As of the 29th of November 2025, they still had about $8.9 million available for further repurchases. This signals confidence from the management in the company's stock value. It's interesting to note how they've reorganized their business segments. They now have three main segments: Uniform, Facility Service Solutions, First Aid and Safety Solutions, and Other. This reorganization is based on how their chief executive officer views the business and allocates resources. This is important because it shows how management is thinking about the future direction of the company. They also increased their quarterly cash dividends, signaling financial strength and a commitment to returning value to shareholders. One really notable item is a significant tax dispute with the Mexican Federal Tax Authority. It dates back to 2016 and involves import taxes and other fees with a total assessment of over $84 million. While a court has made a partial ruling in their favor, there is still a lot of uncertainty. The company believes a loss is neither probable nor remote, so they cannot estimate the potential financial impact, which is a big question mark. In terms of controls and procedures, the company acknowledges a material weakness related to their IT systems, specifically their CRM and legacy applications. They are working on fixing these issues by improving their change and access management processes and implementing new systems. While they've made progress, they expect to fully resolve this material weakness by the end of fiscal 2026. This is crucial because strong internal controls are vital for reliable financial reporting. Now, for my take on UniFirst, they are clearly a stable company with strong fundamentals, demonstrated by their massive retained earnings and consistent revenue growth. Their acquisition strategy in the first aid and safety solutions sector seems to be paying off with strong double-digit growth in that segment. However, the decline in operating income and net income is a clear red flag. The increase in cost of revenues and especially selling and administrative expenses are eating into profitability. They are investing heavily in growth and digital transformation, which is a forward-looking strategy, but it needs to translate into better margins. The ongoing tax dispute in Mexico is a significant wild card and could have a material impact if it goes against them. Overall, UniFirst appears to be navigating a challenging economic environment with mixed results. They are growing, but at a cost. Investors should watch closely to see if these growth investments start yielding better profitability, and if they can effectively manage their rising operational expenses. The resolution of the Mexican tax issue will also be a key factor to monitor. Alright, that is our breakdown of UniFirst's latest filing. What is your take on these numbers and what they signal for the company's future? Do you think their investments will pay off, or are the rising costs a sign of trouble? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description for more insights and discussions. Thanks for watching. See you next time.